Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Andrew Wallace, one of our Government of Canada bond traders. This week's episode is titled, The Focus is on the Front End. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Andrew, thanks for coming on the show.
Yeah, of course. Thanks, Benny, and good to see you a bit more rested today after your travel and that. So, or at least you're looking the part anyway.
Rested. Ha, that's funny. I'll be rested when my kids are out of my house. Bank Canada next week. That was probably the biggest talking point through the trip to London. For those who don't know, I was in London last week, got back on the weekend, took my kid to a hockey camp with his team over the weekend. So I've had 0 days of rest in 2 weeks. Enough about me. The bank was the most talked about item through the trip. Literally every meeting. Fast money, real money, official money, didn't matter who it was. All curious whether the bank would go in September. That almost, funny enough, almost irrelevant. I think everyone agreed that you should be long the front end and they'd be cutting. It was just a question of when. So, yeah. But are they going to go next week? What do you think, Andrew? Where should we be long if all those people are right?
Yeah, I certainly tend to agree that they are going to go. They've gotten the opening, obviously, from the jobs data. Last week's report was pretty clear. The trend that we're seeing going forward is making it pretty clear. Yes, CPI is still running above target. We'll see what next Tuesday brings ahead of the bank, but I think they do have the opening in the sense that they can point to the slack in the market, the uncertainty with trade negotiations. I think it is there for them. And I've been pretty, I don't know what I want to say if I want to say surprised, but it does seem that they do want to speak dovishly when they get the opportunity to, or at least they have the last couple months. So that would be the kicker that I do think they want to go. And I do think they have the opening barring a much higher inflation report next week. Having said that, I don't think market pricing is quite correct before we have that data point. If you look at what we're pricing for the meeting, we're essentially 90% priced. If core is setting 5% or 5 beeps above target right now, that could normalize, of course, during the meeting gap. But, with that pricing, 90% probably seems a little bit rich. Whether we see some profit taking or CPI moves that from here, not sure. But I do think they go. I just don't think there's a trade in the front meeting gap or September anymore, just based on the pricing being fully there.
I'd rather be paid.
For sure. I think that's, especially going into the CPI report, I think you want to be paid before that. Yeah. Because if it is in line and core is 3%, then you probably get some questioning of whether they will go, and you probably see that pricing back off a little bit. So I think there's probably a few beeps in that trade even before the event. And then you're playing potentially a higher inflation print, and they pause for another meeting, which I think they have the ability with where policy rate is to do that. So I think it probably is, a better risk reward trade for sure. And, there is the potential that they don't go. I would tend to agree with you on that.
All right. So yeah, risk 2 to 3 to make 20-ish. Yeah. You're probably not making the 20-ish, but
no, but it's it's a cheap option.
Doesn't take much, exactly. Yeah. Not there. Yeah. So we spent, I spent most of the trip telling people that they wouldn't be cutting in September. And then Friday comes when I'm on the airplane and I see the number.
Yeah. I'm sure your discussion centered around that data point as well.
It did. Yeah. So we caveated it with, if the unemployment rate goes up to 7.1 and you get a soft inflation report, then they're probably cutting. But beyond just the 7.1 on the unemployment rate, the details were pretty bad. The breadth of the softness in the job number was not pretty. And the bank, you're right, they are looking for an excuse, I think, to some extent. They've been talking very dovishly, and as much as I hate changing my mind, when the facts change, it can change. And so we flip to a cut unless inflation really accelerates, which would mean probably something like 0.3s on the cores. Then things get a little bit dicey for them. But my personal inflation worries are my problem.
Yeah, exactly.
They don't. That doesn't resonate with the bank at the moment. What I guess my angle was more that like they've talked about not being as forward looking, which for me means that they're somewhat questioning the relationship between the output gap and inflation.
Yep.
But if we've reached the point where the output gap is so big that that's just like, okay, at this point, the risk is that we're not going to cut soon enough and the output gap will be so big and inflation ends up being so low that we might as well just go. So I think that's where we are.
Yep.
I still have serious concerns about inflation personally.
Oh, for sure.
I mean, I look at my bills in my life and I'm pretty sure everything I do is exactly the same, yet somehow everything costs way more.
Yep.
Like we had a leak in our basement and then there was some mold in the walls. This was like 3 months ago. And then we got it taken care of. And then we cleaned up some other garbage in my basement. And then we found the same thing kind of at the other end. And it was like, oh man, I could do this again.
Yeah.
And they wanted to charge us 50% more. And I think my wife got them down to like 30 or 40%. And it was
3
like,
months.
It's like, dude, it's like, you're literally the exact same job. And they're like, yeah, they knocked off a couple $100.
And then from where that was a year or two ago level too, right? Yeah.
So like these little incremental things in food prices, like I can just see it. And it concerns me that, nobody seems to care about inflation anymore. I find it odd, including central bankers. But
now, I mean, what this will be a part of the broader discussion as we go on here. But then now we're talking bond curve dynamics, right?
Yeah, I don't know. It's hard. I find it pretty hard the way the market just doesn't seem to care about inflation at all.
Yeah.
Or I mean, maybe not as much as I think, but maybe that's why we've steepened as much as we have. Maybe that's why globally 10s, 30s is where it is.
Well, arguably under that dynamic, if people don't care about inflation and you have central banks that, especially south of the border, that, pivot quite dovishly and act pretty aggressively, do you get that bond market saying like, no, we are extremely concerned about inflation longer term. And though we have steepened, like, what's to say that doesn't really take off?
Oh, I think it probably does. That's where the risk is. And in the past few days, so like post-job numbers, we flattened really hard. I think that's really just positioning. And after the this morning, it's Tuesday, September 9th in the afternoon. After this morning's payroll revision, when we rallied for, I don't know, a minute and then sold off immediately.
Yeah.
That just tells you where positioning is. It's not like 900,000 less jobs is particularly great news, or it's going to keep the Fed from cutting. If anything, it makes it more likely that they cut more aggressively.
Yeah.
But nonetheless, sell off right across because everybody very, very long, very, very much in steepening.
Yeah, US 530s. You look at the price action US 530s over the last 3 sessions, right? You get the soft jobs report, power flattens. Okay, is this a Friday trade? Positioning squeeze continues through Monday. And now it's, resuming as the day wears on today. So that's 3 full days of, that curve flattening on a soft jobs report. So yeah, very telling in terms of position, steepeners and obviously short the long end.
Yep, definitely. So that was, September meeting was the big theme. I guess something I should have covered more in retrospect is how far are they going? And the fact that everyone was just kind of in the camp of the bank cutting. We have kind of 3 more cuts. That's the BMO call officially. I was kind of leaning toward 2, but I think it's just more a function of what happens next year with USMCA.
Right.
And that's where I feel like the market kind of isn't priced quite right. If you look at Z5 through M6, it's pretty flat. I think that's -6, and H6 M6 is flat. That doesn't make any sense to me at all. Like I don't know how you don't price anything in for the middle of next year when USMCA is up for renegotiation on July 1. So that's an inconsistency I see in the market, I guess. But
I guess along that line, do you think that's a consideration for the bank, or there's just so much uncertainty around it? And the reason I ask that is I don't disagree with the trade. I think it should be, an inverted curve there for sure. Does the bank look at where policy rates are, say they do go again next week, you're down to 250. Do they save some potential cuts for uncertainty through 2026? Or are they just looking at the data and their view of the economy and acting that way? And if they do have to cut further down, say to 0 or close to it, they'll be prepared to do that. Like, do you think it's a consideration for them to save some ammo, call it.
I don't think they look at it that way. I think they're going with the data. So as it comes, they'll do what they got to do.
Yeah.
I'm sure their eyes are on that very much so. But you can't know the outcome. And so when you don't know what's going on, and that's part of why they've said they are less forward looking, because there's no way of knowing how that's going to unfold next year. And that's probably the most undertold story in Canada.
No one's talking about it.
I don't get it. It doesn't make any sense to me. I mean, it is like the risk of USMCA kind of evaporating. And I honestly think it's very low at the end of the day, but there's no world in which President Trump has been kind to Canada in the past year. So I'm not sure why the narrative is going to be at all positive for the next 6 or so months. But why is no one talking about this? Why are we not pricing in a little bit more in 2026? That is where the opportunity is, I think, going into probably Q4 and 2026.
And it probably just is, there's a lot going on currently. Near-term outlook, you could argue this is a little bit further out, as you mentioned, into 2026, so the market just hasn't moved on to focus on this yet. But to your point, that's what creates the opportunity, because the market will focus on it. It has to. So if you're the first one thinking about it and there are opportunities like these core future flatteners, median gap flatteners, those type of trades, then yes, absolutely, this is probably the right time to be thinking about it.
I think so. Also, Canada, US, and I'll beat that drum when the time comes. But maybe not this week, but the next episode perhaps.
Yeah.
What about your part of the curve? So Andrew trades 2s through 5s, maybe a little further out. That curve has been stubborn, I guess, to put it kindly. It doesn't move.
It's been kind of, 2s 5s has been power flattening here for, a handful of sessions now. Yeah, it's been interesting. I mean, I guess the last few months probably worth the backdrop of it. Canada loves housing, loves talking about the housing market. We're going to do that. Through the spring period, you kind of had a mortgage curve and outright rates that suggested that, refis and new mortgages that were taken out, a lot of them would be 5-year fixed, which we haven't seen in a number of years. The hedging flow that came through was suggestive of that as well. But kind of through the summer, that flipped as kind of curve steepened. 5-year mortgage rates got north of 4%. 3s, 5s mortgage curve got 30 plus basis points. It seemed like a lot of the mortgages being taken out in the fixed space were 3-year, and that put some flattening pressure on the 2s, 5s curve through kind of August, call it. And then as we head into the fall, that dynamic of what these 2020 refis look like could very well determine, what the 2s, 5s curve does through the fall. A lot of questions on the curve as to, how it's flattening 2s, 5s into more aggressive bank pricing and expectation the bank's going to cut. Really what it's been is 5s are just generally leading the rally right now. The market's rallied, 5s have been leading, 2s, 5s has flattened, 2s have been pretty stable, but during a market rally, just that curve, the 5-year point has outperformed. I don't foresee that necessarily changing. The bank, might catch some people off guard, but if the bank does cut, if inflation comes in line and the bank goes, I could see 2s, 5s flattening further and 5s leading the rally, belly-led rally, call it. So it's been interesting. I think once we get through this meeting, focus will shift to an extent, not just to future meetings, but to what the housing market does and what the structure of mortgages look like through the fall. As of this morning when we were looking at it, we haven't got an update on where 5-year mortgages are, but I'd say they're, call it 410 to 420% based on where they were in late August at our last posting and versus, the rally we've had since then. The 3s, 5s mortgage curve would have flattened over the last week or so with the 2s, 5s curve flattening, but it's still probably 20-ish basis points. So it could be that until you get to 4% or less 5-year mortgages and that curve is more like 10-ish basis points, people could still be taking out shorter term mortgages at this level. If that is the dynamic through the fall, then you'll probably see this persistent flattening pressure in the 2s, 5s curve just from the hedging of those trades, i.e. paying a 3-year rate versus receiving a 5s to hedge the deposit. So we don't know the answer to that yet, but that's something we're monitoring obviously very closely just because that can drive the direction of our 2s, 5s curve in Canada.
So I guess at the end of all of that Treasury receiving benefiting the 5-year sector ends up reversing itself at the end of the day. Like it pulls 5-year mortgage rates down, then you get people coming into their fives, and then there ends up being paying, and then it goes the other way.
Exactly.
Right,
so it's where's the inflection point, I guess, is the question.
I don't know.
Maybe it's sub 4%, as simple as sub 4% in 5-year fixed. Maybe that's the level that people will take out.
So that's April, May, in there is when the share of 5-year mortgages of origination started to go higher.
Yep.
And then it leveled off in June, either May or June. I'm assuming you got more leveling off through the summer just because the flows we've seen would make a lot of sense. So then the question becomes in the fall, there's still a lot of refis to go through October from 2020. But then after that, activity does kind of fall off. So there may not just be enough activity. Even if the mortgage curve looks right, you may not have sufficient volumes to offset a lot of the needs on the deposit hedging side. So. That's something to keep in mind, I guess, still.
Now, I'd say, too, obviously, we have to note, I mean, kind of goes without saying, but 2s, 5s will be a directional trade, too. So if you do get a sell-off, the market generally selling off, reversing some of this recent rally, 5s will lead that weakness versus 2s, especially with, the way our data is progressing, the outlook for the bank, that probably hasn't changed materially near term, whether they go intercept or not. But so it is a directional trade in the sense that 5s will lead weakness versus 2s, I think, if the market does sell off.
Fair enough. I get that.
Yeah.
2s, 5s is going to be challenging to steepen. So but further out the curve, you guys still like steepening, 5s, 10s, maybe less so, but 10s, 30s, 5s, 30s.
Yeah. I mean, we've been talking about a lot the last couple of days, just given the price action and what's gone on kind of in this flattening move post-week data on Friday. What's changed?
Nothing.
Yeah. And we can get into some of the budget in Canada for sure and, what that might look like, what issuance looks like on the back of that. But really nothing has changed. If anything, the recent data and events we've had are suggestive of further steepening. So why is the curve flattening? We hit on it. Positioning pretty clearly was one way. But once that goes through and you get back to the fundamentals of the market, I think you do want to be in steepeners. 5s, 30s, 10s, 30s in Canada, we think makes sense. 2s, 5s is challenging as we've hit on, so we tend to try to keep it a little more clean there. But yeah, 5s, 30s, 10s, 30s, we do like steepening. We just haven't seen a ton of appetite for bonds other than short covering, even at these cheaper yield levels.
That's the question. So at one of the, we hosted a dinner with a number of clients around table in London, and one of the very astute clients asked the table, what is going to bring back demand for long bonds anywhere? It was a global question. Why are people going to suddenly come back and buy 30-year bonds? And I don't think anyone at the table even attempted to answer the question.
Yeah.
We just kind of moved right along.
Yeah.
And the only answer that I have is when you think there is real money to be made on capital gains effectively, you think that rates are going to rally a ton. So that means either inflation is going to come down, or central bank independence is not an issue, or all of the fiscal spending is going to go away and reverse itself.
Right.
I don't see any of the three of those things happening anytime soon. And so I have trouble seeing anything but steepening, even if we get a positioning washout, maybe we flatten further. But a year from now or something along those lines, 6 months, the year's pretty far out, 3 to 6 months, still steeper for me.
Well, it just seems, in my opinion, and I guess our desk opinion, it just seems like a very skewed risk-reward trade. And, a bit broader, but I think there is, an underpriced possibility that if central banks become very aggressive, they're cutting, that the bond market is going to reject that further out the curve. You see a lot more discussion coming up about that. We've seen events in the past, UK, whatever it is, where, the bond market just doesn't accept some of these decisions. And I think there is a risk that occurs in the US on a very aggressive Fed, or, if it does progress somewhat like it seems right now. So, yeah, I would just find it very challenging to be in flatteners further out the curve in the 30-year sector, say, versus the belly right now, because I think there is a risk that it goes significantly.
So all that being said, I think the Canadian fiscal situation is a little bit different. Expectations, I think, here are pretty heavily skewed to a lot of stimulus coming. I think most everybody thinks there's lots of money that's going to be spent. I'm not really in that camp. I mean, a lot will be spent.
Well, I guess a lot will be spent, but it's versus expectations.
Exactly.
Yeah.
Let me be clear. They're going to spend a lot. The deficit will be large, but I just don't think it'll be quite as large as what people think. And I think we're probably already priced for that. That was one of the other things that we talked a lot about while overseas. And I guess from a market perspective, I think it means more for swap spreads than for curve. Like it should help our curve if there's not more supply. I think supply is probably about steady. So maybe that helps. I think it helps on a relative basis as opposed to on an outright basis. Like if global curves are steepening, Canada is also steepening. We just don't move as much.
Yep.
But in swap spread land, I think that's a bit different. Like I think we've cheapened a ton. There's some room for us to balance, especially I think in like the 10-year sector. Twos are probably a bit rich at the moment, but 10s have cheapened up a lot. And given where the expectations are, the risk is probably skewed the other way now. Again, risk reward.
Yeah, and I guess too worth highlighting. I mean, when we got our issuance update in the summer, there was a buffer built in. They didn't increase bill issuance quite as much because they said additional issuance requirements. We can absorb some of it in the front end first, and that's kind of the plan. So, it seems like the plan is in place for more issuance, and the front end can absorb some of that. So I think, I tend to agree with you in the sense that we probably are expecting whatever is going to come further out the curve in terms of supply. You want to tack on the provincial issuance, like all those programs are well ahead. So I don't think that's a major factor, at least over the next 6 months, where you're going to get more supply than expected. If anything, it's probably a little bit less based on how much they've done. But
on the Provi side, that should be reflected in credit, though. Like soft spreads should be a Canada thing. I separate the two that way. So like a bunch of people brought that up, and they're like, "Do you not put them together?" And I look
like
at the
for swap spreads.
Yeah. I look at the Provis more as like if there are more Provis, then it means wider spreads. If it doesn't mean that much at the end of the day for swap spreads, I don't think. I think that's where it should manifest itself. I might be wrong. I'm open to being wrong there.
but I don't disagree. I don't disagree further out the curve in terms of 10s and 30s, the impact for swap spreads.
Yes. In sort of inside of 10s, it's a different story.
Yeah.
That'll totally
inside 10's different for sure. But I can see where you're going with the swap spread trade. So I guess that kind of leads you into, as you go through the fall and things playing out is, long Canada versus US and liking that further out the curve, right?
Yeah, I think so. Well, I like long, like 10-year Canada swap spreads against the US or against really anybody. I guess like you want to be. You probably don't want to be outright long spreads in case of some fiscal event or something like that, and the world blows up and swap spreads collapse further. But I do like Canada on a relative basis, at least, or something curve related. Like you mentioned 2s and 5s, like the front end being able to absorb issuance. Like they could probably take more. 2-year auctions could get bigger. 5-year auctions can get bigger.
100%.
We can do more T-bills, and I don't think that's the case with 10s and longs. Like those auctions have not gone as well.
No, it's a very the outcomes in the auctions in 2s and 5s have been consistently different than 10s and longs for a little while now. And that's just suggestive that our front end can absorb more issuance.
So if you need to add a yard to both of those, that's probably where it goes first. And I think probably more T-bills also. But that's why I think it also makes sense to buy those 10-year spreads. I think like a 2s, 10s spread curve steepener makes a lot of sense to me here, especially given where 2s are.
And then in the bond space, would you say that you'll look for opportunities then to get, call it long, the Canada-US 10s, 30s box or something of that nature?
I would prefer to just be long Canada 10s against US longs or Canada-US 10s, Canada-US long, either way.
Yeah.
Like just be long Canada against the US. The curve, I guess, works. I'm not comfortable enough with the flows to...
Sure. Yeah.
I think the box you need to be more tactical with. I don't think it's a structural trade.
Yep.
And I think you can put on a long Canada-US structural trade for probably, I don't know, through most of the fourth quarter and probably into Q1. Like you get December 1 flows, you get USMCA talks, you get more Bank of Canada cuts, especially if you're doing this in 10s. You get exposure to U.S. fiscal problems, you get exposure to Fed independence problems, you get exposure to all the things in the U.S. that are really weighing on their curve.
Yep.
And I also think you get the Canadian fiscal kicker if they don't do anything, if they don't add issuance in tens and longs.
Right.
So that all makes a lot of sense to me. The timing on that and the level of entry, I think, are the question marks.
Yep.
At this point. I don't think it's now, but I might be wrong.
Yeah.
I do think it's soon, which is why I'm not certain if it's now or not. The level in longs is not great. Like you're at 105-ish. It's not amazing.
Yeah.
I'd like to see that in the 90s. That would be wonderful. Even like mid, high 90s.
Yep.
I'd be much more comfortable. 10s looks probably better here.
Well, yeah. And I think, if you did want to double up your trade, I think, I think the long Canada 10s versus short US 30s is kind of the trade. Yeah. You're playing steep and you're playing the cross market. I think that's a trade that if it goes, it could really, really go. So again, risk reward, in my opinion, on that is skewed one way and gives you an opportunity.
The chart isn't nice. That was one of my issues. I looked at it and I was like, that should be so much prettier, and it's not. And Joel,
have to be careful with some charts.
every meeting when I mentioned Canada US, that Joel went to Canada 10s against US longs pretty much every time. But then I looked at the chart and I was like, man, it's
a tough entry.
I wish it was. Yeah. I wish it looked better than that because we're already close to the peak levels, but or I guess tightest levels. But it'll something definitely to watch for. I think over the rest of the quarter. Yeah. Any other trades? Anything else you like that stands out at the moment?
No, I think we've hit on a lot of them. The Canada US is very much recently trading in line with your thoughts. So I don't disagree with that. I could see that going further. I do like steepening, as we said, for the reasons. The 5-year point, as big of a move we've had like in 2s, 5s, 10s over the last bit, I kind of like being long the 5-year sector right now. Like I said, I do think the bank's going to go. The market is trading bullishly for the time being anyway. I think that trade will continue to perform near term, and then we'll have to reassess, as we develop through the next little bit, what the mortgage hedging flow looks like and how we go. So I don't mind being long the 2s, 5s, 10s fly, even though it has richened. It's not a trade you hold for a long time, but I think there's probably a couple more beeps in that. And then just generally like steepening. So we just look for opportunities to kind of get on core steepening positions. And then the front end, I do think your core future flattener, median gap flattener makes a lot of sense. The market isn't talking about the trade negotiations at all yet. Obviously we will. So I do think there's an opportunity there. So I'll look more into that, but I could get on board with that trade too. But yeah, I'd say those are kind of the main ones.
Okay. Thanks for coming on, Andrew.
You're welcome, Ben, anytime.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.